Hello entrepreneurs, welcome to NOBOSS TV discussion 13. Let's get started. In the previous discussion, we talked about office essentials to get you organized and be more efficient. Now in this discussion, we're going to talk about the legal structures for businesses. My goal is to inform you and give you the power to protect yourself and allow you to make the best decision for yourself. Now here's my disclaimer. I am not an attorney, so I am in no way advising you to pursue a specific business entity for your new business. I do strongly advise you to speak with your attorney, your personal accountant, or your local state agency regarding the best business entity for your specific financial situation. So what is a legal structure? A legal structure is a form of business organization. So the terms legal structure, business entity, they're all the same thing. Just depends on who you're talking to. Once you decide on the legal structure for your business, then your rights, responsibilities, and obligations of everyone involved apply. So, who's involved? The key players are generally you, the owner, your partners, your investors, and any potential shareholders. So, why do you need to worry about this? The fact is, you have no idea how well your business is going to do. I mean, it could literally be successful beyond your imaginations. It could far exceed your goals. Or it could not do so well. And not to say this lightly, but whichever way your business goes, you and the business need to be protected. Also, choosing the best legal structure will also be important to your lenders and your vendors because it gives them a level of legal security when lending you money or extending credit terms to you. So, let's take a closer look at the different types of legal structures. The first is sole proprietorship, which is simply you and the business that you own. Now, because it's not incorporated, you and the business are one and the same. So unfortunately, if a customer or say an employee files a lawsuit, then they are essentially suing you personally. However, to your benefit, the business does pay its own liabilities and debts. But it is for you to consider that when you choose a sole proprietorship, you are choosing to personally take on the profit or the loss of the business on your personal income taxes. So consider your financial situation and whether you want to take on more income or less income on your personal income taxes. Now, just as the sole proprietorship gives you full control, the same applies to a general partnership. It is simply an arrangement between you and your partners to agree to conduct business jointly. No special filing is required, just standard business license as you would any other business. Each partner contributes, whether it's money or property or labor or skills. Someone may have an idea, someone may know how to execute that idea, someone may have the money to support the business. So contributions vary in partnerships. Each partner can act on behalf of the business without the permission or the knowledge of the other partners. Why? Because you all share in the management of the business. Now, with this shared ownership means that each partner shares in the profits as well as shares in the losses. And with that comes the shared liability of the debts of the partnership. Now, the business doesn't pay income taxes, and that's because instead it passes through any profits or losses to each partner so that each partner can include those profits or losses on their own personal tax returns. So if it's a 50-50 partnership, that's a 50-50 share in the profits and a 50-50 share in the losses. If you choose to start out as a sole proprietorship or a general partnership, know that once your business starts to grow, both you and the business begin to expose yourself to greater liabilities or greater risks to your own personal assets. And this is when you may want to consider upgrading, if you will, by incorporating for that added protection. Becoming an Inc. should be a simple and easy transition, of course, with the added perks. The exchange of money and property initially invested becomes the corporation's capital stock. The Inc. separates you and protects your personal assets from the business. You can also begin to establish your business credit, separate from your personal. The Inc. allows you to take the same deductions as a sole proprietorship, along with some special deductions to figure its taxable income. Now, if you're a sole proprietor incorporating in your home state, you really don't need an attorney. Also, there's several reputable online sites like LegalZoom to assist you, or you can always go to your local state agency if you choose to do it yourself. However, if you're a partnership, things can get a little complicated. In that case, you may seek legal advice and assistance. The limited liability partnership, or LLP, works a little differently, although it's when two or more partners conduct business jointly, and again, the partners contribute to determine the ownership shares. It adds protection because it too separates and protects your personal assets, but it also limits your liability according to the interest you have in the business. Now, your interest in the business, in which one or more of your partners are liable only to the extent of the amount of money that the partner has invested. One specific thing about the LLP is a partner doesn't have personal liability for the negligence of another partner. So, if there's 3 or 4 partners in a business, one partner is negligent, all partners are not liable for one partner's actions. This is a significant difference in the LLP. Now, when it comes to the limited partnership, the LP, it is almost identical to the previous LLP. However, the general partner is significant in the LP because the general partner has an unlimited liability, while the other partners have a limited liability. And that is because the other partners do not take an active role in managing the business. So because the general partner takes an active role in managing the business, their liability is unlimited. Those were the incorporations. Now let's look at the different types of corporations. The C corporation is the most formal. You have to file an article of incorporation with the Secretary of State. And, well, with all of these, the costs are going to vary. But with the C corporation, you must have a board of directors, you must issue stock, and you must hold an annual general meeting. Now, the ownership is determined by who owns stock. And that's great if you plan to go public, your IPO, because you can raise financing by issuing stocks. However, whoever owns the stock can transfer the stock. They can sell the stock. For federal income tax purposes, a C corporation is recognized as a separate tax-paying entity. Investors and owners are not generally liable for the debts and the liabilities of the C corporation. Now, your C corporation conducts businesses, it realizes its income or its losses, it pays its taxes, and then it distributes the profits to the shareholders. Now, the C corporation does not get a tax deduction when it distributes these dividends. So the profit is taxed in the C corporation at the point that it's earned, and then it's taxed to the shareholder when it's distributed. Now, this is a double taxation, and shareholders cannot deduct any losses for the corporation. Unlike the C corporation, the subchapter S or S corporation is much simpler to run, and it too is formed on the state level. However, with the S corporation, you do need to qualify. So there are some requirements for you to meet. With that said, the S corporation does pass corporate income, losses, and deductions through to the shareholders for federal tax purposes. The shareholders and owners report the flow through of the income or the loss on their personal tax returns, and they're assessed taxes at their individual income tax rates. So taking on that additional income profit or less income loss on their personal tax returns. Now, this allows the S corporation to avoid that double taxation that you saw in the C corporation. The liability of the S corporation is again separate from the owners, so the S corporation handles their own debts and liabilities because the owners are not liable for that. Now, the limited liability company, or the LLC, is formed on the state level. The costs vary by state, but it's very similar to the sole proprietorship or the partnership in that you have the option of being treated as an S corporation, and you can take advantage of both business types. Now, this is ideally suited for small and new businesses. It's simple, it's inexpensive, it's easier than a C, it's easier than an S because there's less rules, there's less regulations, and less legal compliances in general. And there's no impact on your personal assets. It limits the liability of its owners. It does not pay a federal income tax, and that's because it passes through that income to its members with no tax at the entity level. And all the assets are owned by the LLC. Now, I'm sure at some point you've probably heard about incorporating in a different state because it's cheaper for tax purposes. And some entrepreneurs and their partners decide to do that, incorporate in another state. However, when you do that, you need a registered agent in that state of incorporation to represent you. And again, once you speak to your attorney or your personal accountant, that's when you decide if this extra step is beneficial for your business. Are you really going to save somewhere or make that much of a difference by incorporating in another state? That's your executive decision. Now, one thing I want you to be aware of is the silent partner. A silent partner is just that. They're silent because they're not involved in the managing of the business. And we know how being a general partner and managing the business can affect your personal assets or your level of liability. Silent partners they're most often involved in LPs or LLCs. They have no authority to act on behalf of the business. Their role is simply to contribute capital to the business in return for interest on the profits. Now, being a silent partner does afford them the right to review your company financial statements and have a voice in the decisions that affect the changes or the nature of the business or the existence of the partnership, because they do have a vested interest. The other type of partnership will be a joint venture partnership. Now, joint ventures are generally short-lived, so it's something that's set up and registered, but it's only done for a specific reason. And ventures like this, they're only necessary when a project is going to be really complex or requires a specific management team or a certain operating structure that's separate from the business. It's more of a project-based type of protection for the partnership. And it needs to be a partnership because contracts and agreement to set up this separate thing, that agreement can't raise capital. But a joint venture partnership, it is now a formed business. It's a joint venture. It can raise capital. So that's the benefit of putting together a joint venture partnership. But again, it's short-lived. The next is a nonprofit organization. Forming a not-for-profit organization has strict government guidelines to qualify as such, first of all. And you want to make sure that your nonprofit maintains those guidelines and not risk losing that status. When you compare a nonprofit organization to a for-profit organization, you'll see the differences. You know how a business operates. But for a nonprofit, they promote a cause. They accept donations. Now, they can generate profits, but those profits have to be used to preserve the existence or expand the organization. They can't establish themselves and receive the status of a nonprofit and then start just selling stuff. The next one is they recruit volunteers. Now, they can hire staff, but that staff has to be in direct support or in direct execution of work related to the cause of the organization. The assets of a nonprofit cannot be taken or divided, I should say, by the founders if that nonprofit ever dissolves. You don't split it up and say, you own 50%, I own 50%. All of that stuff has to be sold off, because remember, that nonprofit is receiving donations. You do file the articles of incorporation in your state. It's treated as a corporation in terms of rights and privileges, but it also has that additional privilege of being a nonprofit organization. Yes, they are exempt from federal sales tax and property tax. However, they are not exempt from payroll taxes. So if a nonprofit has employees, they're paying payroll taxes just like every other corporation. They are not exempt from tax on your profits. So those profits that are made from activities not related to the main purpose. So if you're selling something and it is making profit for your nonprofit organization, if that profit and what you're selling is not related to the main purpose, your main cause, then you will be taxed on that. So there's certain things. So if you're selling books and it's related to the cause, you are exempt. But if you decide to sell t-shirts that are not directly helping the cause, they're just t-shirts to promote the cause, promote your organization because they're cute, then you're going to be taxed on that non-related item profit that you're selling and generating. Which brings me to your reason for failure. Or I should say a reason for failure. Failure to incorporate early. In partnerships, it's common for a partner to drop out early, a year into business or whatever. They drop out early. However, if you decide to go public in the future, your business is doing great, a partner could return demanding some equity because they were one of the original funders. And this could be avoided had you incorporated early, issued shares to the founders. Then at the time that that partner dropped out, did they still hold those shares? Did they sell those shares? It would have been resolved at the point that the partners dropped out. So this is one of the reasons why some businesses fail, because something like that could be crippling. The next one is your task. And then what I want you to do is go online and start searching for those legal requirements. What business license are you going to need on the federal, state, and business level? Where are you? How are you going to incorporate your business? Are you just going to make a run down to the state agency? Do you have an attorney that you need to talk to? Is it going to be simple where it's something you can do online? But I want you to start researching that, decide which one is best for you, and then update those costs in the legal requirements section of Workshop 1. And of course, that cost is going to go into your overhead startup budget. This concludes discussion 13. Click that like and subscribe button below. And remember, a real boss has no boss.